most people, when they try trading on their own, end up losing money. How long did you go before you became profitable, and how did you know? Like, when did you realize, hey, I didn't just get lucky. I'm onto something here.
It took me 3 good years to figure it out and get profitable at the beginning. So I didn't go all in and blow up in that 3-year period, but it took me 3 years to find an approach that worked for me. And that approach was systematic trading. 3 years of basically struggle and frustration to find a method that fit my personality, fit my objectives, fit my lifestyle, and that I could really resonate with and build confidence with.
What does your typical day or week look like? How many trades do you put on, and how do you squeeze it all into just 30 minutes?
The trick for fitting active trading into a busy lifestyle is to do the work up front to decide on what's going to trigger an entry and what's going to trigger an exit. With systematic trading, the rules determine exactly when you get in and when you get out. Systematic trading is much faster, much easier to fit into a busy life.
And what type of stocks do you pick? I mean, do you just pick any kind of stock, or do you stick to like a few that you know really well?
The great thing about systematic trading is we develop a set of rules that we apply to the entire market, or to a section of the market, or a sector of the market, or the constituents of an index, something like that. And those rules are developed to work on that part of the market.
I'm kind of surprised that you trade all stocks. I thought you would have said something like you only go for like mid cap or large cap or something, but it sounds like anything that fits the profile you're going to consider.
Yeah, anything that fits the system will give a signal. The system, as I say, the systems will target different parts of the market. So
at the end of the year, what kind of a return do you need before you tell yourself this was a good year?
Well, the important thing is my goals are not your goals, right? So I have a certain risk tolerance. I've been doing it a certain amount of time. I've got some experience in it. I'm very well diversified. So therefore, based on all of that, I aim for what I aim for. The problem most traders have is they aim too high. They've got a small account. They want to get rich, so they go hard. But that's exactly the wrong thing to do. What we should be doing is saying, I've got a small account. I'm going to trade this so that I can survive no matter what happens. And I'm going to save, and I'm going to add money to my account, and I'm going to trade conservatively, and I'm going to stay in the game forever. Because if I can stay in the game and compound, no matter what level of return I get, over time, I'm going to build serious wealth.
This is the Money Seed Podcast, where we discuss all things investing, plain and simple, the way it should be. Please remember, this show is for educational and entertainment purposes only and is not intended to be investment advice. Welcome back to the Money Seed Podcast. My guest today is Adrian Reid. Adrian is the founder of Enlightened Stock Trading, and Adrian has been a successful and profitable trader for over 20 years. Adrian, welcome to the show.
Thanks so much for having me, Gabe. Thrilled to be here. I'm really excited about this. I've heard a bunch about the different things you talk about on the show, and I think we've got some really good topics we're going to get into today.
Yeah, let's get into it. I mean, most people, when they try trading on their own, end up losing money. And I've heard stats, it could be as high as 80%, maybe 90% of people who start buying and trading stocks online on their own go through some period of loss, and some people never turn profitable. What about you? Like, how long did you go before you became profitable, and how did you know? Like, when did you realize, hey, I didn't just get lucky. I'm onto something here?
Yeah, look, you're absolutely right. The vast majority of people do lose, and we'll probably get into why that is later on in the conversation. It took me 3 good years, 3 bad years, let me put it that way, to figure it out and get profitable at the beginning. And during those 3 years, I tried lots of different methods. I tried fundamental analysis. I tried buying companies that I recognized. I tried buying companies with good products. I tried tip sheets, broker recommendations, analyst reports, technical analysis, price action, all sorts of things. And really, as I worked through that from frustration to frustration, I was basically just losing money consistently. I never lost huge money because I'm very good and very strict on risk management, and I'm a cautious and risk-averse sort of person. So I didn't go all in and blow up in that 3-year period, but it took me 3 years to find an approach that worked for me. And that approach was systematic trading, which means purely objective, rules-based trading. So if A and B and C happen, you buy. If D or E happens, you sell. It's no debate. There's no subjectivity. You know exactly when to get in and exactly when to get out. And having rules like that was the game changer for me. So that took, I mean, there's a lot of detail in the journey, which we may not have time to get into, but 3 years of basically struggle and frustration to find a method that fit my personality, fit my objectives, fit my lifestyle, and that I could really resonate with and build confidence with. And you know that ultimately is the key, having a method that you resonate with, that you can build confidence in, and that you can prove is profitable. Because let's face it, a lot of methods folks use just, it's a hope. It's not, you know, you can't measure it until well after the event. And that's a big challenge.
Believe that you had a full-time job during this time, and it seems like, correct me if I'm wrong, but you typically trade for no more than about 30 minutes a day. And so
Correct.
maybe like, yeah, take us through, what does your typical day or week look like? How many trades do you put on, and how do you squeeze it all into just 30 minutes?
Yeah, good question. The trick for fitting active trading into a busy lifestyle, whether you've got a job or family or whatever it is to do the work up front to decide on what's going to trigger an entry and what's going to trigger an exit. So most people, when they're making trading decisions, they're analyzing charts, looking at company information, looking at news, drawing trend lines, drawing support and resistance, and planning each individual trade they're going to make. And when I started out with technical analysis, that's exactly what I was doing. And it was taking 4 to 5 hours a night, every single night, to do my scans and analysis and draw up my trade plans and figure out what I was going to do the next day. When I went systematic, that's when everything changed, because with systematic trading, the rules determine exactly when you get in and when you get out, what stocks you buy, what stocks you sell, all of the details. And so systematic trading is much faster, much easier to fit into a busy life, because you do the work up front to design the rules, test the rules, ensure they're profitable, ensure they're stable, consistent, robust, and build confidence in them. Then deploying the rules is actually very easy, because the daily process is update your historical data. So get in the stock market data from the last session, run the back test to generate the signals for buy and sell for tomorrow, place the trades, record your decisions, record your trades, and then done. That's it. So we don't need to analyze every single decision, because we've done the work up front to analyze the system. And if we build confidence in the system, we don't have to second guess or overanalyze each individual trade. We just follow the system. The system's doing the decision-making work for us.
So you mentioned two things there that I found quite surprising. One was that you mentioned software and you mentioned backtesting. So
Yes.
this sounds like you either wrote software yourself or you're using software. Can you tell us a little bit more about how are you using, what kind of software are you using to help make these decisions and entry and exit points?
Yeah, absolutely. First thing I want to say is I'm not a programmer. I'm not a tech guy by background. I'm trained as an engineer, so I'm good at numbers analysis, but I'm not a coder. So I didn't create my own software. There's off-the-shelf software to do the back testing, to do the signal generation. I use Amy Broker and Realtest right now, but over my trading history, I've used quite a few different software packages. And what you do, the way systematic trading works, is me as the trader, I put my rules into the software and then use the software to do the testing, to do the analysis, to see how those rules would have performed in the past. The big mistake that most traders make is they assume that a strategy is going to be profitable because they read it somewhere, or it sounds sensible, or it looks good on a chart on the few examples they've looked at. But the reality is most people are hindered by way too little data, way too little visibility of what that strategy actually does in the real world. And when we use a software-driven approach to backtest, we can test over 20 or 30 years of data or more over thousands of stocks very, very quickly. And so we can build a lot of confidence in how that strategy performs, how deep the drawdowns would have got, how many losses in a row we would have, how big the winners are, how big the losers are, all of the stats that's required to build confidence in the strategy. And I think this is one of the big reasons why most people lose money, because they look at a few charts and go, oh, look, there's a profitable signal. Oh, look, there's another profitable signal. Oh, that one's a loser. Oh, don't worry. I probably wouldn't have taken that one because of the thingamajiggy that was going on in the chart there. Or they justify to themselves, and, oh, look, there's another good profitable signal. And they've got 10, 20 profitable signals. They go, great, I've got a strategy that works. I'm going to throw money at it. But the sad reality is that's so insufficient because markets are noisy. We need a lot of information, a lot of data to prove that a strategy is going to be profitable, and a lot of data over a long period of time, because we need to take into account bull markets, sideways markets, and bear markets, so we know how the strategy truly performs in all market conditions.
So getting back to the 3 years of trial and tribulation, I think a lot of people would have given up probably well into year one, maybe 6 months in. I think that's one of the reasons why a lot of people kind of tried for a little while, doesn't work, it's not for me, and they move on. You stuck with it for 3 years. Good on you. At what point after those 3 years did you realize that, hey, I'm actually onto something? I didn't just have a lucky streak or something. I actually have a system and it's actually working.
Yeah, I think your point about, your comment about most people will quit in their first year because it's not as easy as they thought. I mean, that's big, right? Because people look at the markets and make the mistake that it's easy to buy and sell. So therefore trading is easy. And the mechanics of placing a trade are easy, but becoming a profitable trader is not easy. It's actually a huge competition, and only, you have to be good to win and survive. So how did I know that I was actually profitable and not lucky? I plotted for the first 3 years, and actually for many years, and even now, I plotted my daily equity for my account, just for my own tracking and records. And what I saw in the first 3 years was basically a gradual downward sideways, the occasional peak, a little bit of hope. Oh no, I lost money. Oh, a little bit more hope. Oh no, I lost money. And I could see my equity basically just dribbling very slowly down. When I implemented my first systematic approach, my first trading system, that turned around on a dime and my account started growing consistently. And it wasn't just because of one trade. It was because of a portfolio of trades that were moving in the right direction. And you sort of, when you put a strategy in the market that you have confidence in, that you've back tested, that you've seen how it performs through good markets and bad markets, and then you put in real production and you see it doing exactly what you expect and picking up the sort of trades that you thought it was going to pick up and skipping the trades that you thought it was going to skip and cutting the losses where it was supposed to cut the losses, it's not luck. It's rules driven. If I was subjectively making the calls, then it's very hard to know luck from skill for quite some time, because you can be lucky for an extended period of time if you happen to be in sync with the market. But most discretionary traders eventually go out of sync with the market and end up losing a ton of money. But I wasn't making any discretionary calls. The strategy was doing exactly what the strategy was supposed to do. And I was following it. I was getting the right prices, the right stocks, the right position size, the right outcomes, and it was working. So it was really just that, the system is I'm taking the same trades as the system took. System made money. I made money. This is the way.
So I've heard the adage that it's easy to buy a stock, but it's difficult to sell a stock. In other words, we can just buy one, but it's like, when do we actually sell it? When do we get out? That is actually difficult, right? I mean, if it's going up, then you say, oh, well, maybe if I just hold on to a few more days, it'll go higher. If it's going down, it's like, oh, maybe I'll hold on to it a bit longer and it'll turn around. I'll get all my money back. Tell us a little bit about your philosophy about letting winners run and maybe cutting losses, and how do you manage that?
Yeah, the psychology once you're in the market is huge. It is a real challenge because almost all of us are triggered by money, in some way or another. Greed, fear, anxiety, lack, whatever it is we've got from our upbringing, our childhood, our adult life, it makes being in the market emotionally charged. So knowing when to sell is a huge challenge. So my approach to letting winners run, cutting losses, all of that depends very much on the strategy. So there's different ways of making money. Let's talk about a few generic strategies. We can talk about trend following. We can talk about mean reversion. We can talk about rotational momentum, and we can talk about seasonality. 4 generic strategies that I quite like. In trend following, the way to win is to buy stocks that are going up and hold them while they continue to go up. And when they're obviously not going up and they're now going down, you sell them. If you buy it and it immediately goes against you, you're going to sell it fairly quickly, because what you're trying to do is capture a big long uptrend and keep your losses small. So for trend following, you get in like on a breakout on a new high price and you hold it until you get a new low price. Let's say you might buy on a 200-day high and sell on, a 25% stop loss or something like that. That way, when you get onto a really big winner, it's going to be huge because you're just following it up. And when it falls 25% from its peak, let's say, you get out. This is for stocks, mind you. And if you buy a stock thinking it's a trend, but it wasn't, and then it falls 25%, then you get out. I'm using 25% as a generic illustration. Don't go, implement that immediately. It should be tested and validated, whatever. But it's a good rule of thumb. It's about right for most stocks. So for trend following, you're really trying to let the winners run, get big winners, and have small losers. In that type of strategy, you'll have 30% winning trades, 70% losing trades. The losers will be relatively small. The winners will be quite large. So that's how you make money. A small number of big winners, lots of small losses. With mean reversion, it's quite different. For mean reversion, what we're trying to do is bet against the overreaction in the market. So a stock's going up. A bad news announcement comes out, people panic, the stock tanks for a couple of days very heavily. So 3 big down days, for example. At that point, the stock looks terrible. No one wants to buy it. Often that's the very best time to buy it because that's the extreme of the emotion. People are like, hey, everyone's dumping the stock. So you buy it there in anticipation of that emotion coming out of the market and there being a recovery. And this is a very high probability setup. Strong trend, sudden panic. You buy expecting a small bounce. So we're getting in on panic, buying, and as soon as there's a bit of an uptick, just a small little rally, you're getting out and you're catching a small profit. So the profile of wins and losses is quite different to trend following. We're getting lots of small wins and the occasional larger loss. But the math works out profitably because let's say we make a certain amount when we win, we lose a certain amount when we lose, but we're right most of the time, 70 or 80% of the time. So the mathematics comes out to give us a positive expectancy. Expectancy is the equation that determines whether our strategy is profitable. So mean reversion and trend following are almost opposite in terms of the profiles, and getting out slowly in trend following, getting out really quickly on winners in mean reversion. Is this making sense?
Absolutely.
Yeah, cool. So the other two strategies, so rotational momentum, that's where you buy the strongest stocks. And then a week or a month later, you measure the strength of all of the stocks. And if those are no longer the strongest stocks, you sell the ones that are not the strongest and you buy the new strongest set. And you just keep buying into the strongest stocks. This works really well on like the NASDAQ 100. If you just keep buying the strongest 5 to 10 stocks, again, you need to develop the precise rules of the strategy, but as a generic concept, you can rotate into strength continuously on like the NASDAQ 100 stocks, and you can
And sorry to
well
interrupt, but yeah, how do you define strength in this example?
Oh, that's a great question. Look, there's all sorts of formulae that you could use, technical indicators that you could use. One of the easiest is just rate of change. So, how far has the stock moved up in percentage terms over the last 20 days, 60 days, 100 days, 200 days? You can use how far it is above a moving average. You could use like a volatility adjusted kind of strength, like how many volatility units it's moved in how many days. So there's a range of ways you can do it. They're just momentum indicators. But just starting with, say, rate of change is a good place to start, and then you can build some extra layers into the strategy to refine it and smooth it out a little bit.
And I think the fourth one you were talking about would be seasonality, right?
Yeah, seasonality. And so with a seasonal strategy, the payoff profile depends very much on what the seasonality kind of behavior that you're capturing is. So for example, a Santa Claus rally, at the end of the year, stocks tend to rally, have a positive period from end of November through to late December, early January. Typically you get a bit of a trend following profile in that. So you get a number of largish winners and a small number of losers. The overall market tends to lift. My preference for a strategy like that is I have the seasonal tendency and then I overlay a trend following strategy. So I'm only going to buy stocks that are going up, and I'm going to do it when the seasonal profile says it's a good time to buy. So that's one seasonal profile. There's another seasonal pattern where there tends to be strength at the beginning and end of the month and weakness in the middle. So again, depending on the markets, right? So each market is a little bit different, but that would be a much more precisely timed strategy. And so you would be long at one point in the month and short at another point in the month. And that would have more of a mean reversion style payoff profile. So smaller wins, every now and then a larger loss, but most of the trades would be winners.
And what type of stocks do you pick? I mean, do you just pick any kind of stock, or do you stick to like a few that you know really well?
Yeah, great question. To be honest, I think most of us delude ourselves that we know something really well. Like, oh, I've watched Apple stock. I know Apple. Like, I really know how Apple moves. Like, do you really? I take the position that I know nothing about any of the stocks. And I think that's really important because relative to the person who actually knows, who really is the specialist in that stock, most of us know absolutely nothing. And so can I really make a decision based on how one particular stock behaves? Probably not, unless I've spent years studying it. The great thing about systematic trading is we develop a set of rules that we apply to the entire market, or to a section of the market, or a sector of the market, or the constituents of an index, something like that. And those rules are developed to work on that part of the market. So I have some strategies, some systems that I apply to the entire US stock market, all stocks, everything listed. I have others that apply to just the S&P 500 or just the NASDAQ 100 or just a particular ETF. So it's the system that determines which stocks you should trade. And the system and the universe kind of go hand in hand. You build the system to work in that universe. Does that make sense?
It does, yeah. I mean, I'm kind of surprised that you trade all stocks. I thought you would have said something like you only go for like mid cap or large cap or something, but it sounds like anything that fits the profile you're going to consider.
Yeah, anything that fits the system will give a signal. The system, as I say, the systems will target different parts of the market. So, for example, I've got a very broad-based trend trading strategy that will trade any stock. It'll scan every stock in the US market, right? But it won't take a signal in. It won't get a signal in all of them because a lot of them get filtered out because they don't have enough liquidity. A lot of them get filtered out because they're too volatile. And then we need the setup conditions for the trend trading strategy, which has to be breaking out. It has to be moving up strongly in the short term. It has to have a very smooth long term kind of behavioral profile, and all of that is defined through the system rules. So it'll scan the entire market, but there's a lot of junk it will never generate a signal in. Does that make sense? So it's not just I'll trade any stock, because a lot of them are not tradable. They're too illiquid. The spread's too wide. They bounce around too much. The overnight gaps are crazy. But we can scan all of those stocks, and the system rules will discard them and find the stocks that are generating or behaving in a way that will generate a signal.
Fascinating. And out of curiosity, how many different positions do you have on at any given time?
Yeah, it can vary a lot, from literally zero. I could be completely out of the market if nothing is signaling. That would be fairly rare, through to upwards of 100. Because I have quite a few different strategies running, some of those strategies would hold up to 25 or 30 stocks just for that strategy. And so you imagine if I have a trend following strategy for the Australian market, for the US market, for the Canadian market, for the Hong Kong market, that could be 20 positions each, or even a few more for some of those strategies. So it can be a very broad portfolio. So each position is very small. Each position in of itself doesn't matter. It's not going to make me rich, and it won't send me broke. But that's the key. No one trade should be able to hurt you. And the more broadly diversified you are with the more different strategies, and the smaller your trades are, as long as they're not too small, the smaller the trades are, they can't hurt you. Yeah, you might take a little loss, but it's going to be a little loss. It's not going to devastate your account. I've been trading a long time. I've taken, many tens of thousands of trades in my journey. And I've had positions where I've bought it and it's been going along fine. And then the next day it went to zero. Like literally, it was a corporate fraud, company delisted, bankrupt, never heard from again. Like, that's a devastating loss, right? But the position is so small. It's like, well, that's annoying. Okay, next trade. Like, it really doesn't matter. It's not ideal, and I'm not trying to be flippant about it, but this managing catastrophic risk is a really important part of surviving as a trader. For the trader who's got 5 or 6 of their favorite tech stocks in their portfolio and they think they're diversified, eventually something's going to come along that's going to really hurt you. Whereas if you've got multiple systems that cover different strategies, different markets, different timeframes, and each system has many positions and each position is really small, it's pretty hard for an extreme event to hurt you, especially if you trade long and short.
And I think that's excellent. That's excellent advice for anybody that's trading is you got to manage the risk. And one great way to manage the risk, as you mentioned, is just not have one single stock, one single position take up too much of your portfolio. The flip side of that, of course, is then you also, in a way, you're capping your upside. Like if you have a position and it goes to the moon, it's like, well, it's only a small part of your portfolio. I guess you're right, though. You always want to protect your downside. On the other hand, what kind of a return are you happy with? Like at the end of the year, what kind of a return do you need before you tell yourself this was a good year?
Look, I mean, market returns vary fairly dramatically year to year. I've had losing years and I've had 150% plus years. So, it varies a lot. It varies much less now because I'm so heavily diversified and I'm sort of converging. And my goal is to converge, to have my my portfolio perform at around the 25 to 30% return per year over time. I don't get that every year, and sometimes I overperform, sometimes I underperform. But for an individual, the important thing is my goals are not your goals, right? So I have a certain risk tolerance. I've been doing it a certain amount of time. I've got some experience in it. I'm very well diversified. So therefore, based on all of that, I aim for what I aim for. The problem most traders have is they aim too high. They've got a small account, they want to get rich, so they go hard. But that's exactly the wrong thing to do. What we should be doing is saying, I've got a small account, I'm going to trade this so that I can survive no matter what happens, and I'm going to save, and I'm going to add money to my account, and I'm going to trade conservatively, and I'm going to stay in the game forever. Because if I can stay in the game and compound, no matter what level of return I get, over time, I'm going to build serious wealth. And I think that's the key. But if someone tries to get rich by next week or next month or next year with a small account, it's a guaranteed recipe for disaster because you're taking too much leverage, you're position sizing too aggressively, you're trading too frequently, and all of the mistakes just mount up. The psychology, the impact of that is just horrible. Make massive mistakes and you end up blowing up. You've got to survive long term. So survival is always first, profit is second.
Well said. And I just got to say, like 20% is amazing. I mean, if you can consistently average at a 20% rate, that is phenomenal. I mean, there are, hedge funds that can't even do that. I mean, that's very impressive.
Yeah, as a private trader who's systematic, we have some huge advantages that the hedge funds don't have. We can get in and out of stocks that they could never trade, right? Because they just have too much money they've got to move around. I'm not playing with billions of dollars. I've got a retail account. I mean, I've got a good size account, but it's not like I move the market. Well, I need to be careful with some stocks to make sure I don't move the market because, illiquid stocks can be moved pretty easily. But that's the key, right? We have advantages that the funds don't have. And I think also we care about our money more than the funds care about our money. And the funds care about keeping our money. We care about growing our wealth. And those are very different objectives, right? So a fund who cares about keeping assets under management wants to keep everyone comfortable. They don't want people to be unhappy. They don't want people to feel like they're really missing out. And this is key because if we give our money to someone else, when do we feel like we're missing out? When they underperform the benchmark. So funds typically perform or aim to perform right at their benchmark. Actually, they go a little bit below the benchmark because of their expense ratio. But they aim to track that benchmark fairly closely because then no one gets annoyed with them because, oh, look, it's just what the market did. It's our benchmark. We did well, see? We matched our benchmark. So no one really takes assets out of a fund because they matched the benchmark. You take money out of a fund because they underperformed the benchmark. So their objective or their incentive is to match the benchmark. My objective is to build wealth. They're pretty different things.
Absolutely. Yeah. And it's almost human psychology as well. Like if in my mind, I'm saying, okay, I'm going to invest in some mutual fund. I'm going to get, let's say 8%, whatever, let's say 8%. If I only get like 1% that year, then I'm going to be upset. Like you said, okay, I'm not even at the benchmark. The market did better than I did. I only got 1%. I lost out on 7%. But people don't really get upset if they only get 8 instead of 15, because they're like, well, 8 was kind of my goal anyway. I could have invested in something else and got 15. I lost out on 7, but people are not upset by that. Like you said, people are pretty happy with the benchmark most of the time, and they only get upset, like you said, if they're underperforming the benchmark. So that's an
And
interesting bit of.
It is, and there's a lot of challenging psychology in money and investing, as we sort of mentioned earlier, expectations and reality, and what was promised, and what the benchmark did, and what we did. All of that makes these choices around this quite difficult. I make it a very sort of big objective to decouple myself from any of the benchmarks. Like, I don't really care what the market did. I just want to trade my systems, trade them well, and I want to improve my portfolio of systems over time. Okay? Because sometimes I'm going to overperform the market dramatically. Sometimes I'm going to underperform the market just because I'm different than the market. But the fact that I'm different means I have the potential to outperform long term. If I'm the same as the market and I'm correlated to the market, it's pretty hard to outperform unless you're just taking the market and leveraging it. But if you do that, some extreme event's going to wipe you out eventually. So I don't want to do that. I want to be different to the market. So my daily correlation with the market is pretty low.
Adrian, let's move on to your online courses. You're the founder, and you run the website called enlightenedstocktrading.com, where you teach others how to trade your systems. How long have you been running it? And tell us, what can people find on your website?
Yeah, I've been teaching trading for over 10 years now. The reason I started teaching is because in 2012, I quit my job. I quit the corporate world to trade full time. I made more money trading than I did in my corporate job, and I had a pretty good corporate job. I did well that year, but it was just horrible. I was burnt out, and trading was making much more money, or was making the same amount of money with much less effort. So I started trading full time. But then I found I was bored and lonely and depressed because I had no one to talk to. So I started to talk to traders and teach trading. And that's where Enlightened Stock Trading was born. So over that time, I've basically learned how to share my skills, learn how to accelerate other people's journey. And so my main program, the Trader Success System, is really a shortcut to systematic trading mastery. So what we do is I have a 5-stage process. The first stage, launch, is about getting people into the market with a systematic approach. Here's a system. Actually, here's 2 easy systems. This is why they work. This is how they work. This is how you run them. And this is how you manage your risk. So you can start, basically get a sense for it. Stabilize, the second stage, is about building confidence, backtesting, understanding exactly how the systems will perform, and really analyzing them, answering your own questions, challenging them, so that you can build absolute confidence in the strategies. Then we talk about diversifying across different strategies, different markets, different timeframes. And then we automate so that we can diversify even further. And then there's a mastery level where you do, fancy sort of analytics to really deepen your kind of understanding of how the markets work and how your portfolio performs. So we sort of take people through that journey. And what I found, or what we're able to do now, is from nothing, for the right person, an analytical sort of person who has fascination with the markets, we can take them from beginning to mastery in 6 months and have them fully automated with 3 or more systems in their portfolio, fully automated within 6 months. So I faffed around for 3 years trying to figure it out. That's not required, but it will happen if you do it on your own. But if you've got the map and you know exactly what steps to take and exactly what to do, it's nowhere near 3 years. We can do it in months. So that's what we're doing. We have a group of people. We work through the program. I work through the program with them. We have weekly mentoring, and we basically answer questions and guide them through the material. They trade my systems, and then I teach them how to build their own systems. So it's a blast. It's so much fun because I get to talk to people about what I love. I'm not lonely anymore, and I get to see other traders succeed and no longer blowing up their accounts and wasting money. So that's basically what we're about, is empowering traders to win long term.
And how much does the course cost?
Yeah, so the course, depending on which combination you do, there's different levels of mentoring and so on. So we're talking between sort of $4,000 and $10,000 for the program. Part of that is for the training materials and the systems, and part of it is for the mentoring. So it'll depend a bit on the package, and obviously a little bit on exchange rates and all of those sorts of things. What we're doing is building or training traders to have a new career they can do on the side to build wealth for a lifetime. So the great thing is you can really run this alongside what you're already doing. I did for years until it became my main thing. And so people can have their day job. They can have a low maintenance, systematic approach to trading, which allows them to build wealth. And, gradually, maybe you can phase out of your day job. Maybe you can bring forward retirement, or maybe you just end up a little bit wealthier, or a lot wealthier at the end of the day. And it doesn't require the investment in an Ivy League school, or the 4 years it takes to study at university or anything like that. It's just a blast. So to help people get to consistency, profitability, and confidence early is just such a gift. I really enjoy it.
I'll definitely put that link into the show notes, and I encourage everyone to check out your website. There's a lot of goodies and freebies on the website, so go check it out. Adrian, where can people reach you and follow you?
Yeah, the best thing to do if you're interested in what we've talked about today is go to enlightenedstocktrading.com/free. There's a link there. You can put in your name and email, and you'll get a whole bunch of free training, a free system, some ebooks to really expand on what we've talked about. And then we'll be in communication because we'll have email contact after that. If you want to look on social media, Enlightened Stock Trading on Facebook, YouTube are the best. I've got a lot of material on YouTube, so if people want to understand a little bit more, there's plenty out there that I've released for free so that people can learn about systematic trading.
Fantastic. Adrian, thanks very much for your time today.
Absolute blast. Thanks so much for having me on the show.
Hey, thanks for joining us for another episode of the Money Seed Podcast. Please remember to click like and subscribe. It really helps spread the message to other investors, and it helps attract new viewers to the show. We appreciate your support. Thanks very much.